Thanks for tuning in. I'm Sara Kennaugh from Company Matters, Link Group's Company Secretarial and Governance Advice Team. In this episode, we'll be playing back highlights from A Year Ahead, a recent event where a panel of experts were discussed corporate governance trends expected in 2022 and beyond. The conversation covers a range of topics relevant to shareholders, investors and issuer companies, including ESG, dematerialisation and the future of AGMs. When you hit play, you might have been expecting to hear Jay Baker, the normal host of this show. Well, worry not. Jay was on the panel, so you get to hear plenty from him shortly. I'll let Jay and the other guests introduce themselves, though, when we dive in. This event was part of our Ahead programme for corporate governance professionals. It was also our highest attended event to date, so if you're not already a member and would like to get involved, just click the link in the description for more information and you can sign up. I hope you enjoy.
Good morning, everyone. Welcome to the Ahead webinar, our first one for 2022. We've got a great panel today. I'm going to let them introduce themselves. So first we'll start with Melissa Kittermaster.
Thank you, Sara. Good morning, everybody. My name is Melissa Kittermaster. I'm the Chief Executive of Assessoria Group. We're a professional services company and we work across sectors. For the past 20 years, I've been focused on board evaluation, sustainability, ESG, stakeholder engagement and non-financial reporting.
Thanks, Melissa. Jay, over to you.
There we go. It worked. Thank you, Sara. Good morning, everybody. I managed to unmute myself. I'm Jay Baker. I'm the head of industry here at Link. I'm the head of industry here at Link, and I'm looking forward to discussing some of these very important messages and features of 2022 that we are about to embark on.
And last but definitely not least, we have David Chase Lopes.
Good morning and Happy New Year to everyone. My name is David Chase Lopes, and I'm the Managing Director for the UK and EMEA for DF King. We're very active in AGM work, securing shareholder support at annual general meetings, as well as M&A situations and activist defense work. So we'll look forward to participating in the call today. Thank you.
Thanks, David. So we've got quite a packed agenda, so I'm going to move straight on to ESG. It's something that, to be honest, we could spend the whole hour on. And in fact, we will be spending more time on it as the Ahead programme later on in the year. I think it goes without saying that ESG reporting is a good thing. Nobody's arguing that. But companies are struggling with the uncertainty around reporting. So perhaps, Melissa, I could start with you. We've got the FCA's mandatory comply or explain regime for premium listed companies introduced last year. The UK statutory obligations being introduced for financial years starting on or after the 6th of April this year, and existing statutory non-financial information disclosures. So there's quite a lot going on already. What are the key areas of overlap between them?
Well, if I start with the FRCs, as you mentioned, that came in at the beginning of last year, so we'll be reporting it for a number of companies this year. That is just focused on premium listed companies. But the FRC is introducing again this January, so just as from 1st of January, the requirement that standard listing companies and also those in terms of asset managers and pension funds and others will also come in, so they'll be reporting next year. And as you say, alongside that, government is going to be introducing requirements to report for climate-related disclosures based on TCFD, which will come into force from April, and that is going to capture a greater number of companies. So at the moment, it's comply or explain through the FCA. And that the reason they've done comply or explain rather than making it mandatory is they recognise that organisations are still trying to gather data that actually currently may not exist. So they realise that it's going to be a journey and that we're not going to get there in one fell swoop. So it's encouraging companies to report. And the idea with the government legislation that will capture a greater number of companies. And I think moving on to sort of 2025, we're going to see that much more private companies, probably smaller private companies, will be captured. And again, I suspect that will be extended further because, as you know, that's a major agenda item for the government in terms of their focus on sustainability and climate-related disclosures. As we're touching on other areas in terms of Comply and Explain, the FRC are also introducing this year the requirement to report and extend on diversity reporting, which is both premium listed and standard listing. And so they are looking to increase the threshold that was already a target as such, or a guide from the Hampton-Alexander Review and also the Parker Review, to increase that threshold of female board members to 40%. And also not only female members, but also them to have a key role in the board. So one to either be CFO, the chair, the SID, or CFO. So again, looking at them to be a key role on the board as well. And also to support the requirement to have one director of colour also on the board. So again, supporting some of the things that we've already seen companies already reporting on, but again, more focus in terms of those listing rules and what are the requirements. And then, of course, we already have the non-financial reporting requirements. We have section 172. So there's also lots of things that I would suggest we are still reporting on, still trying to improve the way we disclose, increase transparency where we can. So the list is getting longer rather than shorter, and a lot of things for companies to consider.
Thanks, Melissa. Yeah, I always find it fascinating about the difference between what people have to report on and versus what they choose to report on, and the sort of disparity sometimes between what they need to report on versus what their investors want them to be reporting on. David, perhaps I could bring you in at this point. What should companies look out for in their next annual report and prepare for during 2022?
I think from an ESG perspective, a lot of it has to do with what some of the points that Melissa has mentioned around transparency. But generally, we think with our clients that if the group is trying to tell a story about why the board is fit for purpose today and tomorrow, and that they're weaving in their ESG story across, let's say, the general preparation of their conversation on the AGM, it's very helpful because it helps, whether they're publishing things directly or complying with regulation, telling their ESG journey through these different axes is quite impactful. And we notice that it allows them to be directly developing their dialogue on these subjects with not only shareholders but stakeholders, but also making sure that their constituencies can look at their ESG strategy from the perspective of the company and hammer home the idea that the board as it is conceived is doing the right things and is evolving the way that is hoped for, let's say.
Thank you.
You're welcome.
Melissa, I'm sure you can add to that as well from your perspective.
I think one of the big focus for this year, of course, for premium listed companies is to be reporting against TCFD. Quite a few companies have already started. Some did it last year and some had previously been reporting. But for a number of companies, that's going to be the biggest hurdle, is how can they articulate clearly around climate-related issues, their governance, their strategy, and the scenario analysis that is expected under some of the risks is also going to be a challenge. Thinking about those metrics and the targets, not just around scope 1 and scope 2, but some of the others around other elements around waste and the use of their scope 3 and the value chain is going to be the greatest, I think, challenge going forward about how they do that. And also start to report on what that transition plan looks like, the transition plan to net zero. We're looking that we think legislation may come through in sort of 2023, 2024 from the UK government about having to report on a clear transition plan and not just a target that we're going to hit 2024. So I think around the climate, over the big ones for me. I also think there needs to be more probably in terms of organisations articulating how they engage with their stakeholders. A lot of them will talk about how they engage. They're not always very good in terms of what the stakeholders are asking for, wanting, and their perspective, and then what action the company is taking to address some of the stakeholder concerns. And I think that's the piece that's missing. And some information, one of the reports from the FRC last year was about companies expanding their reporting on stakeholder engagement. And the other area I think I'd finish with is more detail around purpose and ensuring that the purpose is clearly articulated and how that feeds into the business model and their strategy, so that there's a clear link with the organisation's purpose and how they're reporting against and how that links into those social values.
Yeah, no, very, very important. Just staying with you, Melissa, but thinking about that stakeholder piece with all these requirements, and especially in regard with the AGMs, do companies and boards in particular need sort of new strategies to tackle these challenges, both at the meetings themselves, from say an activist perspective perhaps, but also in general terms?
I mean, for me, to know your stakeholder is really, really important. And, as everybody knows, is to be very clear on who are your key stakeholders, and not just shareholders and not just employees and customers, but other interested parties, to really know and map that and really understand that, and to also understand what's material to them, and then the different methods of engaging with them. And we're very good at engaging with the shareholders in most cases. However, I still understand from investors that there's more, they feel that companies are not perhaps as proactive as they need to be, and are often very reactive. And I think it's only if you are proactive with your stakeholders that you can really understand where they're coming from, what the challenges and their expectations of you as an organisation and in your reporting, that you're then able to respond to some of those challenges, because you're almost aware that, I know what's going to be raised from this particular shareholder, etc., and are able to manage that more effectively. So I think it really is about knowing your shareholders, engaging with your shareholders, and being able to have that open dialogue on an ongoing, proactive basis rather than reactive and being on the back foot.
Thank you. Jay, perhaps I could bring you in at this point to, for your views on the same question, really.
Yeah. Thank you, Sara. And just to counter Melissa just slightly, I think that, to be honest, to break down ESG into its constituent parts, and I would suggest that much is already being done. Comprehensive information is already available in most company annual reports and standalone publications, as well as investor presentations. So companies are now seeking permissions, for example, to offer digital meetings, which meets all the ESG points. Companies are increasing the number of non-statutory shareholder meetings, especially in advance of the AGM, to improve that engagement. Some companies have or are looking to hold those very stakeholder meetings that Melissa referred to allow that stakeholder voice. So that all meets the S and the G. And for many years, companies have sought to increase electronic communications to address the environmental impact. But not all of this is in the gift of the issue of company. And we have to remember that shareholders and stakeholders alike must take some steps to engage socially themselves with their investing companies, and to do that in an environmentally friendly manner. Perhaps government could also do something a little extra, as they did with SEGA when SEGA came in as a temporary measure during the pandemic. That helped with the AGM proposition enormously, and to digitise that. So that's what I would say. Carry on with more of the same, and just I'd like to see a little bit more engagement from companies in doing all of that.
Great, thanks. David, anything you'd like to add before I move on?
Just say in terms of these subjects that really ESG is pretty much at every point of the agenda. If you think of, and I would highlight that it isn't just E, and what I mean by that is that when you look at E, it's effectively an opportunity at the AGM to talk about, say, on climate, but it also could be an opportunity to discuss why your board of directors has the talent and the skills around environmental questions, around climate, carbon emissions, et cetera, that is fit for purpose, or how you're trying to develop that board skill set and how it ties into your specific ESG strategy. And also, obviously, stay on pay. Everything that has to do with remuneration hits almost every level of ESG, including extra financial quantifiable criteria that more and more as a prerequisite are seen as really being locked back into your ESG strategy. And if we think of S, you get, again, we've talked on the diversity issues of a board composition, say on pay as well, because more and more there is the question about the equitability, the equity or the fairness of pay between the lowest paid and the highest paid corporate officer. And that's something that's obviously important. And even when you get to G, obviously the board of directors is being voted on. So they have to be able to demonstrate their competence, their ability, and their ability to listen to shareholders and stakeholders, how that ties into purpose, but also ultimately getting strong votes for all the resolutions from a high quorum is vital to demonstrate that in general, this company has the support of its constituencies.
So, David, on the subject of the board, do you think companies need to have specific ESG expertise on the board?
It would depend a lot as an ideal best practice. The question then is to make sure whatever the structure or board chooses, that it's fit for purpose for them and where they are in their journey. So we're advising, for example, groups on the continent who are not willing yet to do a say on climate, but have very developed ESG strategies. If you think back to all the effort that's been done in the French market since the COP21 in 2015, where they have a real ESG story to tell, and that they need to say, this is what we're doing on say on climate, but this is what we're doing with ESG directly. And these are the skills that can do it. I think we recommend that these committees get established. And if they can't do it, they explain why still it works. You know, a lot of them, it's harder to keep it in the audit committee today, I'd say. And there has to be a cohesive and coherent approach to it. If you have whatever the ESG strategy is, it has to permeate through so many other levels. And you have to be able to demonstrate that the board can challenge and push back and understand how the management is trying to implement these key strategies, especially if you think that 2030 isn't far away and it's all linked back to 2050 and getting to net zero.
So, Melissa, is that the expertise piece? Is that something you're seeing reflected on the boards that you're working with? Do they have that specific?
They are starting to look at it. I wouldn't say that there are a huge number that would be classed as the ESG expert, just like we often have maybe a digital expert. I think there's 2 points I'd make on the board and their knowledge. I think it's important that every board member increases their knowledge on ESG so they understand how it affects the company and can clearly articulate that. Appreciate that it's a broad area in terms of the different elements that they need to understand. But I also find that sometimes having a single expert on the board is not always healthy. What you tend to have is, as we've seen with the digital, is the translator that will then tell the rest of the board exactly what somebody might be advising on or telling them about. And what you can see is that board members will sit back and think, well, I'm not the expert, so therefore I'm not going to challenge and question. And one of the things that we need to ensure we have is diversity of thinking on a board. And therefore, all board members should take the responsibility of upskilling themselves on ESG, to understand ESG, and to be able to challenge executive and those that are brought in to advise. And sometimes it's those questions, I'm not saying it's the daft questions, but those that are less informed but will actually get to the nub of the challenge or the problem, and will then make the other board directors think in a different way or more laterally about the particular issue. So I'm not saying no to an expert, but I'm saying that other board members need to upskill themselves so that they still are able to contribute, as they should as board members, to any discussion that might be around ESG or climate related issues, which I understand is more technical, but you'd expect that on any technical subject, that both as the responsibility of the board member to upskill themselves, but also as the company to provide training at annual away days and at board briefings so that they can upskill themselves. So I think it's a two-way thing, both the company's support as well as the individual board directors ensuring that they're upskilling themselves on the topic.
Yeah, I mean, effectively, it has to become part of the whole company's culture, top to bottom, to be effective. Do you think the ESG performance, though, can effectively be linked to remuneration?
Well, we've seen over, a number of years that there are a number of elements of ESG that are already being included. So I see clients that have, had health and safety as part of their, remuneration or metrics for a number of years. And I've got other clients that are certainly seeing customer satisfaction as a metric. And now emissions and climate related metrics are being included. And interestingly, one of the potential legislation that's coming from the EU is that there is going to be a requirement that sustainability metrics and those to reduce emissions are on the initial sort of discussion. So in terms of a direction of travel, I suspect that we're going to see more, if not mandatory, but certainly guidance that is what we should be looking for. And I've certainly seen over the last few years, certainly remuneration and the sort of non-financials and those that would be for variable pay performance, particularly being included around ESG.
Yeah, no, and I think it's something we'll see more and more, to be honest. Jay and David, actually, perhaps I could bring you all in here as we go to our final question around ESG. How does a company tell its ESG story in a meaningful way?
That's a good question. If I may go first, Sara, and excuse me, David. Well, as I said earlier, comprehensive information is available in most of the annual report and other documents already. But of course, presenting this well and signposting locations clearly is key. Also thinking of all possible delivery mechanisms, so even including digital channels, I think. So what about the use of social media, for example, to tell the story? These platforms, I think, are perfect to get a message out, and of course, they're global. So that's going to be hugely important to a lot of companies and shareholders and investors alike. So I think all of that delivery channel mechanism has got to be the key for them at the moment in relation to, from what I can answer, from the shareholders' point of view, from the investors' point of view, it's got to be, companies have got to consider how best they can get that message out via alternative means, not simply relying on a printed report, is what I would say.
Well, you're right, and especially, cross-generational investors.
Exactly right.
We're not all, like myself, 40 plus, and like to leaf through the pages.
Yes.
Yeah, very true. David, have you got anything to add there?
Yeah, I mean, a lot of when we work with our clients on how ESG fits into the bigger picture and how they tell that story, it does tie back into telling the board's story and why that board is fit for purpose today and tomorrow. And that it's sort of an inside outside looking experience. They have to demonstrate to the outside world that they have the skills and the influence and the focus to think about these questions in the same way they would think of, let's say, challenging on finance, and then also be able to demonstrate that their mastery of these subjects is such that they can really challenge the implementation at the management level. And I think a great example of a board's ability to manage ESG or tie it into the bigger story of the company is how they have overseen the general response of their company to the pandemic over time, because essentially it is a wonderfully challenging example of systemic risk. And it's a way to demonstrate that the skills overall were fit for purpose and that many various challenges that changed over time or were multiple at the same time were addressed as best as possible, and constantly working not just for shareholder interest, but also for the wider stakeholders, which ties back to maybe where the modern investor is also trying to see focus and also connect companies back to the bigger world, given that we've all sort of experienced this together in a strange way.
Thanks, David. Melissa, perhaps I could move to you for final comment on that question before we move away from ESG.
All I would say, and I think being sort of very boring probably, I always say to companies, don't try and do too much, keep it focused, go back to your stakeholders and materiality, and be clear on why you're focusing on those elements of ESG away from the regulatory requirements. But why are you choosing them? How does that fit with your purpose? How does that fit with your business model and your strategy? And take fewer elements rather than more if you can, but really ensure they're embedded as part of the way you operate, part of that culture, rather than trying to feel almost a scattergun approach and try and cover off too much and have policies, but you're not really embedding it and you're not really getting it into the culture. So that's what I would say. And then, of course, when you get to that stage, everything you do and every way in which you approach, whether it's social media or your reporting, it's kind of like that stick of rock. You've got it going through everything you do.
Yeah, no, that's an excellent analogy. Yeah. Thank you. We could talk about ESG all day, as I said, and we've got quite a few questions that have come through, so we'll come on to those at the end. I'm going to move on to secondary capital raising. Jay, I know this is one of your favourite subjects. So we know the Treasury's launched a call for evidence on secondary capital raising, so with a view to improve processes, reduce costs of rights, etc. Do you think a switch to digital and paperless is the answer? And can it really be achieved without mandating shareholders provide email addresses on their register?
No, good. It's a good question, Sara. Switch to paper and digital. In short, yes. I think an overhaul of the current capital raising processes is well overdue, actually, and the digital approach must be what's firmly on the agenda. Now, why do I say that? Use of digital delivery of information, documents, payments, and confirmations could speed up the process enormously and reduce costs whilst delivering rights securely to all the shareholders. So as it stands, use of email addresses for managing shareholder accounts has been really dependent on issuers, registrars, and the shareholders taking a proactive initiative, if you like, to encourage their use, because it's not mandated. We've made progress, but take up by shareholders is not universal, and therein lies a problem, because in trying to implement a new process like the new way of running a rights issue, we need buy-in from the investor, from the shareholder, to engage in the digital. So without electronic addresses in place, many initiatives just could stifle or be stifled, or even difficult to deliver, include the secondary capital raising. So there is a growing case for mandating email addresses as part of the share register. I'm certainly in favour of it, particularly given that internet use and household access is approaching 100% of the population. So why not do it? I personally think we should be looking to mandate electronic addresses, most definitely. But we'll have to wait and see what happens.
Yeah. When is the recommendations are due back to the Chancellor?
So we had a call just a couple of days ago on it, actually, just to seek some more stakeholder interaction, if you like. We are expecting a report back to the Chancellor in the spring this year, and some report out from the Chancellor's office shortly thereafter, I would imagine. So more to follow. Okay,
thanks, Jay. On another one of your favourite subjects, intermediation and dematerialisation. Not easy to say unless you've had a couple of coffees, which thankfully I have. We know that the Law Commission has said that the intermediated model for shareholding should stay and be improved. What are the practical measures that can be introduced in the sort of short to medium term to improve the model and to improve the exercise of retail shareholder rights?
Very important question. I mean, this has received some interest over recent times. People held within the intermediated model, for those people that are not quite sure what that means in nominee accounts. They don't receive any rights whatsoever, other than the delivery of dividend payments that have been passed down by the registered shareholder. And therein lies a distinction, actually. So someone invested in a company via an intermediated model, i.e. they're in a nominee position. They're not a shareholder, they're an investor. So the shareholder rights are only extended to shareholders recorded in the register and not to the underlying beneficiaries, if you like. Companies who are the registered shareholders will extend rights to the layers of investors below, but it is the nominee that exercises the ultimate right based on the instructions it receives. So it's very convoluted, and that chain is very difficult to manage, I guess, for the intermediaries. So it's going to require, I would imagine, the nominee companies to extend rights to underlying investors, but that includes costs on them. and it rather depends on the contractual relationship it has with its investors. And I think, the nominee companies are not going to be overly excited about increasing costs on its investor, or rather its client base. I think it's worth having a look at what's happened in Ireland and what we've seen in Ireland last year. This to highlight the point about intermediation. So we have a reduction in transparency in Ireland due to the additional level of intermediation caused by the new CSD that came in March 2021. That has led to an increased cost for the issuer in disclosures under its 1062 process, 793 in the UK. We've seen additional complications on the voting and dividend payment flows as well. So whilst we will always have a level of intermediation, do we need better choice for the investor? And I would say yes on that. So back to the UK, we do of course have changes to voting models which allow almost direct access via connected platforms like proximity being a case in point. And could we see blockchain technologies in the future coming in to support, if you like, the intermediated model? For me, the intermediated model does need an overhaul. I think it's extremely complicated, and that then leads on to that question of dematerialisation, I think, and how that might be able to support a better investor flow.
So should the industry and the market be looking at dematerialisation for an answer to the intermediation question? So obviously amongst other questions, but why not concentrate the effort on dematerialisation and ensure it delivers speed, cost, accuracy, security?
Yeah, exactly. Absolutely. Agree to all of that. It does resolve the problem to a certain degree and removes the cost of paper flow for the retail shareholder. And it frees the retail shareholder from the only option that is currently available to them. So it will provide choice. And let's go back again over to Ireland, actually. It's an important feature. The Irish market is going to dematerialise under the Central Security Depository Regulations on the 1st of January 2023. We've got just under a year. And I think we're going to see some learnings from that. Are we going to see in 2023 and beyond the retail shareholder moving out of that intermediated model back to a registered position in the register? I would like to think that they would, and that will prove a point for the UK market. And having a non-dematerialised system is very old-fashioned and not in the best interest of UK PLC. So I would like to see dematerialisation obviously be successful in Ireland. We're going to implement it in the UK, but there's no timetable for that whatsoever at the moment, although the registrars group are constantly pushing for some answers from government and Treasury and Bays on that. So the question was, why not concentrate the effort on dematerialisation? That's certainly in the offing. We are certainly concentrating on dematerialisation. Intermediation is something that also needs to be looked at, and looking at it in the round is what we're doing. So there's going to be a lot more to follow on all of this.
So SRD2, now that presented an opportunity to improve intermediation, but the UK passed on that, probably, I guess, as Brexit was looming. Is amending the current model just too complicated, especially for those institutional investors in the chain? Do we need a new approach to preserve shareholder rights?
That's another very important question, actually. But for me, the clue's in the name. Shareholder Rights Directive means shareholder rights. It doesn't mean investor rights because of those people in the intermediated model. So I know that's semantics. But I think it's important that the definitions are understood between shareholder and investor. There was of course an opportunity to embrace the changes presented by SRD2 and to improve those investor rights through the intermediated chain, but the UK failed to grasp that. So I guess other than voting models like proximity that I mentioned that can deliver across the intermediate chain, wholesale changes to intermediation, as I mentioned, are going to be likely too complex. And I think personally that DMAT is going to provide the opportunity for investors to live outside of the intermediated model, to become the registered shareholder, and by such therefore receive the full rights that they that they would enjoy, as opposed to being in the intermediated model. There's also the question, and we've seen already that SRD2 hasn't delivered for the UK. One would question, has it delivered for the EU? And I would argue that there remains a lack of harmony even now across the EU, with different markets operating SRD2 in different ways. So the concept and the construct of SRD2 hasn't quite panned out, and I think the way that the EU wanted. The UK have taken its approach. Ireland have implemented SRD2, but at the same time have a new CSD in place. We have DMAT coming in Ireland. So a lot of these questions, I think, will remain questions for some time yet, until we're in a position that the end investor and or the current shareholder has choice about where they hold their shares.
Great, thanks. I'll keep an eye on your LinkedIn, Jay, for some updates.
Thank you.
So, AGMs. Whilst some companies have secured a large online attendance at AGMs, circumstances have certainly forced that in some respects. Is it something that more companies should realistically aspire to? And maybe, Jay, I could start with you, since we're on you.
Me again. Okay. Yes, I think so, actually. The problem is we see apathy in proxy voting. For example, last year and the year before, less than 5% of registered shareholders actually exercise their right to submit a proxy. And that represents about 57%, 58% of issued share capital. So there's clearly some apathy, and it doesn't matter whether you look at that in the paper form or in the digital form. I'm talking about that's a combined approach. But there are advantages, I think, to online meetings, and some of those will be from a shareholder's point of view. Of course, there's the removal of travel. You can do it from the comfort of your home, or your office, and it allows access to a broader range of shareholders. So it's not just the same old people that turn up week in, week out to shareholder AGMs in London or Birmingham or Dublin or wherever it may be. You pull them in from everywhere. But I think everyone accepts that attendance and voting are not going to be automatically improved, if you will, via a switch to online technology. Although there are some notable exceptions in the market, and some companies have had some great results in 2020 and 2021 with their virtual or their hybrid meetings. I won't go into those just yet. I think the problem is more about engagement, actually. I think connecting investors is the only way that voting and attendance will increase. And much of the effort can be done online, asking for meeting questions to be lodged on the website, holding a shareholder forum throughout the year, perhaps even developing a regular communication channel for shareholders. But all of that would help. So a little bit more than you're doing today, rather than just relying on a notice of meeting, for example, engaging with shareholders outside of that cycle to bring them more engaged, bring them more into what the company's doing, I think is probably more of the way forward, rather than just jumping straight into a virtual AGM, which I'm sure any registrar would be happy to help with, actually. So
especially us, proactive.
Sorry?
Especially us, surely, Jim.
Oh, especially us, and of course David Chase Lopes at DF King, and of course our colleagues at Orient Capital. But there has to be a proactive effort made, and I mentioned this earlier. It's not just about companies making that proactive effort. It's got to be the investor and the shareholder too. And although there is some cost to holding a virtual or hybrid meeting, I think a lot of that can be mitigated from in the short to medium term, more engagement, better engagement, and a more engaged shareholder base that actually is paying attention to what's going on.
Yeah, no, I do think education of investors, especially retail investors, is very important. I mean, I'll put my hands up. I am a lazy shareholder. I like, I won't tell you the company, but there is one that I invest in that I do get a piece of paper, and I think, I trust the board to do it. They can just crack on with it. I'm not going to rock up, which is shocking considering where I work. But Jay can tell me off for that later.
Yes.
David, Melissa, is there anything you would add to that? Perhaps David first.
Yeah, sure. Thanks, Sara. Most of our work is with institutional investors, and we have seen generally across Europe and the United Kingdom, strong levels of participation. In the UK, despite the issues with quorum levels in the Irish market that often have footsie names there, we're still above 70% for last year. And what we notice is they have, stewardship is absolutely related to voting, and they are very active. But the way that an institutional investor votes, because it isn't directly held, as Jay has indicated, is through their custodians. So they do it electronically, but well in advance. And there's a tremendous amount of conversation and road showing and selling of the board story and the key resolutions well in advance to make sure that the company is presenting the resolution of the AGM and, let's say, in line with general best practice, and when they're not, to be able to apply a legitimate explanation of why an exception should be made. So I don't think that constituency is as focused on hybrid versus physical versus just virtual. However, where it would become much more important would be in an activist situation where everyone would benefit to have the final face-off live in a room with all parties, where anyone who had withheld their votes until the final conversation could do it, or if a resolution were presented in the room, that those who wanted to be represented could legitimately do. That's a sort of a separate skill set in a separate situation, but that would be, for me, the only reason why institutions would have a worldview on it.
Sorry, I was going to ask Sara, if you don't mind, if I could just
no, on you go.
Challenge David, but ask David a quick question. David, what's your experience of other markets, so outside of the UK and Ireland, where hybrid and or virtual meetings are far more popular? Are we seeing that type of activism working in the way you've just mentioned?
So not everyone was successful across Europe to put in appropriate jurisdiction to allow, let's say, hybrids in the first year of the pandemic. So they had sort of closed meetings. And I was involved in an activist situation working for an English investor on a French company, and they had a closed door. So the final face-off wasn't really doable. And they even used the sanitary or the public health rules to prevent having a bailiff in the room. So that was one that was a bit pretty kind of crazy. In other situations, what we see is that companies will apply the law in their interest. They'll do what they have to do. But we did a defense in Belgium where we benefited from the activists not understanding, let's say, AGM rules well enough that they presented their resolutions too late. And because they couldn't physically show up at a real meeting, because there wasn't a physical meeting and there wasn't a hybrid, they weren't able to really put a slate in. So a bit of amateur hour on their part, but at the same time, a little bit of luck for our client. We also had a very large CAC 40 decide to do a hybrid meeting with live questions. And the chairman and CEO is a family member of this group, and they kind of waited online for no questions to be asked. So the big lesson in France after that was, if you're going to do a hybrid meeting and have live questions, make sure you have some in ready just in case. So that's kind of just funny stuff. But one thing, we worked with a very a mega cap from the UK on their AGM, and in so many areas of corporate governance, the United Kingdom is really strong and are always forward thinking. And one of the key issues of differentiators from the UK experience has been that they got the laws adjusted so that you could work through the situation quicker and more clearly than in other countries. And if we have stories in Germany where, especially in 2020, they like to have 20-hour meetings, and And there were people who still tried to sue companies because they didn't have a physical meeting in the middle of, the pandemic period, which was probably its most dire, and there was no vaccine. So you have strange reactions, but my sense is that in anything that's really agent principal approach to AGMs, the UK is very strong, and you tend to find the right path.
Yeah, it's interesting. I think hybrid meetings can sometimes be perceived as quite costly, complex, risky. I mean, we don't feel it because we see them and do them all the time. But obviously, if it's your one AGM, and as David's alluded to, there's a demand from investors to be able to challenge management in a physical setting. Do physical meetings really represent the most sort of cost-effective means of holding an AGM, especially if you don't have a large retail shareholder base?
Well, it goes to the previous question, really, I think. We've seen, think about the shareholder journey, if you will. We've, as I mentioned, we've got the apathy in shareholder voting already. We have apathy in shareholder attendance at the physical meeting. There is some evidence during 2020 and 2021 that some company meetings where a virtual element has been included has actually increased the attendance at the AGM, so therefore making it much more cost effective and inclusive to host the meeting. So for me, I mean personally, I'd like to see many more companies hold a hybrid or a virtual meeting. There is going to be a cost element, of course there is, but I wonder if that's a small price to pay for the encouragement of shareholders generally to participate in, after all, what is their right in the decision-making process. And I think that's where this market in the UK and Ireland needs to go, and we need to follow what the rest of the world have done already.
David, anything you'd like to add to that?
I'd just say that generally what we see is that, first of all, UK physical meetings are short, and on the continent they're long. And it's also related to the view of the meeting and its purpose. On the continent, it's often, this is the one opportunity per year where the shareholders can speak to their board, and they don't want to give away that opportunity. And they're 3 to 4 hour long events. Even go in Germany, it's a bit exaggerated, and there's usually cocktails. I've been to DAC 30 events that had 10,000 people, and it was a bit ridiculous. Or when there was Aventis, which was a French-German company, we used to have to come around and give proof to the German retail shareholders that they had come to the meeting so they could write off their travel. So there's kind of hokey stuff.
I don't know, David. Now, if there was cocktails, I might make it to the AGM of the company.
You just have to. I'll tell you, April and May in Paris.
I'm
I
obviously
love
investing in the wrong companies.
Yes, I love Paris in the springtime because I can go 2 days, 2 times a day to a cocktail party and get a lot of free gifts and stuff. I'm a bit funny, but it is kind of that experience. So to give a sense of when I was involved with that directly, 20 years ago, that was a 400 to 500,000 euro budget. And then in Germany, some of the largest companies that have these massive spreads, it's $1 million, but it's like running a rock concert. In fact, in the heyday of like the dot bomb, I was at the Vivendi event where they had a French musical started the event for Jean-Marie Messier. So you see stuff. And when we did the BG takeover by Royal Dutch Shell 4 years ago in the UK, it was 30 minutes. There was maybe 3,000 people in the room, but it was done and dusted really quickly. And when I've gone to Dublin,
relatively, the costs are certainly different to what they used to be.
Yeah. And there's a factor. I think the other thing around AGMs is what is its purpose in relation to your retail shareholders. And I would say that the biggest advantage in the UK to promote retail shareholders is the tax the tax authority, because that's what holds Europeans back, is that the capital gains are pretty strong and it's not really an incentive. But if these events become a neat way to attract retail investors, to make them feel important and to be taken care of, and to learn about the markets and get close to the decision makers and the board. So, it is important. And I guess also the better you do that, you can manage and really have impact on both sides if you're a shareholder. How you manage your communications with your stakeholders is a lot different, because ultimately a stakeholder has moral suasion but doesn't have a vote. And that's where a lot of the governance issues and corporate purpose and accountability become more challenging. So to a certain degree, getting the AGM right and making it as accessible, inclusive as possible to shareholders is quite important, because the one question we're not asking today is, well, in a stakeholder model, when's the day when you're going to be able to have have stakeholders at your meeting?
Okay, thanks, David. We've only got 5 minutes left, so I'm going to move on to a couple of questions, because we'll probably only be able to get through a couple. And this may be putting you on the spot a bit, Melissa, so please forgive me if it is. And you can always say, I don't know, I'll come back to you. But somebody's asking that when you commented about increasing the threshold of women on the board to 40% and for them to have a key role, they're asking whether that's already in, and if not, when will it come in?
Thanks, Sara, and thanks very much for the question. So my understanding is it's going to be, again, based on a comply and explain. It's going to come in this year. So in terms of legislation or reporting on it, we won't be doing it until next year. Well, not legislation, but in terms of guidance, in terms of changing the listing rules. And it's going to be for premium listed and standard listing straight away, whereas when we were talking about TCFD coming in last year, that was just for premium listed, and then adding this year to standard listing. So it's going to be both, as far as I understand. 40% they're setting as like a sort of threshold or aspirations to move towards. And so it's building on, as we've already seen, and I mentioned before, the Hampton-Alexander review, which was looking to aim to 33%. And before that, of course, we had the Davis review when we were trying to get into the 20%. So this is kind of the next iteration to ensure that there is real diversity on the board. But I think one of the other things is mentioned is not just the 40% of in terms of women and those key roles, which is one of the other things that mentions in that guidance, but also to look at wider diversity. So diversity in terms of background, education, and it's really to really push boards in terms of getting that diversity of thinking, which is obviously what we're looking for, is to ensure that not all the board members are looking at through the same lens because of the same background, but actually looking at through different lenses, and therefore can give a much broader perspective to some of the decisions and the challenges that they'll be facing as part of their role. Yeah, so that's my understanding.
Yeah, cognitive diversity is something that personally I find absolutely fascinating, and that I think it's going to come more to the fore, hopefully. Another question again on ESG, so I'll stick with you, Melissa, initially, is we talked about upskilling the board, but the question is, how does the board upskill? Like, are there specific training programs? Do they, use specific resource materials in your experience? How are they actually attaining that extra skill?
So there's a number of ways I see boards doing that. So we will do some board facilitation sessions in some cases. So that could be just getting the board to work better together, more constructively. But equally, I often see that on away days, there will be particular sections or elements that will be given to covering certain topics. So ESG could be one of them, but we've often seen that around digital, certainly about legal aspects. You'd expect the company secretary to be working with the board to say these are the legal aspects and doing an update, if not at every board meeting, at least on a quarterly basis.
Yeah, no, we have a technical team that is doing a lot of work around ESG at the moment and informing our COSECs, who can then inform their boards, again, so that the boards in turn can be upskilled.
Yeah, so I think that, and I think also, as I said before, it is a responsibility of the individual director to keep them abreast of developments around a number of topics that they would are likely to need to know about in relation to undertaking their role, just as they would have or should have, or we would as executive directors. We need to keep abreast. We need to ensure that we do personal development, and board directors need to do exactly the same.
And that wraps up our session nicely. Thanks again for tuning in. If you enjoyed this episode, don't forget you can subscribe to our channel so you won't miss a single episode in the future. You can also find out about our Ahead programme and how to get involved using the link in the description. Thanks again for listening. Bye for now.